Good afternoon and welcome to the Morrows Monthly Update for September. My name is Luke Lucas and I'm an advisor in the Private Wealth Division here at Morrows. September was a big month on investment markets, with major policy announcements coming out of the US, Europe, China and Japan. We also had some big budget announcements coming out of Spain and Greece. Global markets rallied for a fourth consecutive month in September after the ECB unveiled its latest bond buying program and the US Fed Reserve unleashed QE3. The Aussie market was up about 2%, while US equities were up close to 3% for the month. Europe, Japan and China also posted gains. Safe haven bond yields were relatively flat despite the policy action, although we did see some support for periphery bonds, with yields on Italian and Spanish 10-year notes falling. In commodities, oil was softer in September following a strong August, while gold rallied close to 5% as a hedge against inflation. Most of the other major industrial commodities were also stronger. In currency markets, the Aussie dollar rose close to 0.5% against the US dollar, but that was largely as a result of US dollar weakness rather than underlying strength in our currency, although we are seeing continued buying of the Aussie dollar by offshore central banks. Economic data continues to vary by region. After a reasonably positive August, data out of the US in September was generally more negative. Jobs creation slowed, while manufacturing activity contracted at its fastest pace in more than 3 years. On the positive side, consumer confidence rose, and the housing market is emerging as a major bright spot in the US economy. In Europe, the data went from bad to worse, with both manufacturing and non-manufacturing activity remaining in contractionary territory. The lone bright spot, Germany, is also starting to show signs of pressure, with many analysts expecting a third quarter contraction in economic output. Chinese data remains soft after a disappointing August. Manufacturing activity and industrial production are still soft, but we are starting to see some signs of life in the services side of the economy. Inflation is under control, and the central government announced a $157 billion infrastructure spending program and pumped tens of billions of dollars worth of liquidity into the financial system. Domestically, the Australian economy continues to grow despite the uncertain global backdrop, with June quarter GDP growth coming in at an annualised rate of 3.7%. Unemployment fell, but that was largely as a result of people leaving the workforce rather than underlying strength in the jobs market. At its October meeting, the RBA opted to cut the cash rate by 25 basis points, citing the persistently strong Australian dollar and ongoing weakness in the global economic backdrop. Markets calmed down in September following the global policy action that we saw, with volatility falling. After those announcements, we expect the market's attention to focus on hard economic data. Trading volumes remain light, and we expect any negative news will likely result in an aggressive sell-off. As such, our portfolios remain at their de-risked positions for capital preservation and downside protection. We continue to monitor investment markets and policy announcements, and are ready to move client portfolios to benefit from any market movements. Thanks for your time, and we look forward to speaking with you again next month.